Hey everybody, it's Uncle Gary again. Thank you for tuning in, and I'm super excited to bring you this episode. I've done a lot of research on this, and I'm willing to bet that nobody's been talking to you about this information that I'm going to share with you. This episode is about the stock market and what is going to be happening over the next, say, 30 to 60 days. So I'm predicting there will be a significant change. And my intention and my wish for you is that you are forewarned, forearmed, and ready for anything that comes. So this is not financial advice. I'm not advocating you do anything. Always check with your own financial advisors before making any changes to your portfolios or spending any money. And this is my opinion of what is going to change. And it could be something quite significant. So that's what this video will be about. There is a special offer at the end. It's a little bit of a longer video. Well worth it. I've done a heap of research underpinning this, so go ahead and wait till the end to see what that free offer is. No cost to you. I promise it's a really valuable offer. I use it. It's been a huge win for me, and I'm basically ready for the markets. Whatever comes, I'm seeing the potential for a really big change, and I think it's going to go that way. So I'm getting ready. I'm preparing all of my positions and so on. So that's just an explanation of what I'm going to do, and not that I'm suggesting you do this, but it's going to be an interesting conversation. I will be revisiting this video after the time frame that I've mentioned, so back in January. We'll check back in January. And then the last point I wanted to make, thank you for everyone who's given me feedback. I will be making a video after this one on refinancing your mortgage. Now is a great time, and I'm going to show you my calculations and why I'm doing that. And as always, please go ahead, like, subscribe. That way we keep in touch, and you'll get to hear any new videos as they come out. And you can always give me some comments down below. I literally love it when you guys tell me what you enjoy and what you would like to hear next. So thank you for everyone that's done that, and I'm looking forward to hearing from the rest of you. Let's jump in. Okay. Hey everybody, it's Uncle Gary again, and as promised, here is a new video for you, and this one is going to be a really interesting one. I've responded to a lot of your comments, and thank you for everyone who did add in what they wanted to see. So in this one, we're going to talk directly about some of the stuff that's happening in the stock market. And before we start, we've always got to be responsible. This is not investment advice, so please do not take what I've said and go and do something with it. Just hear me for what the opinion I'm going to present is. Maybe you agree with it, maybe you don't, that's fine. But as always, always do your own research, always arrive at your own understanding of why I'm saying what I'm saying, rather than just taking what I say and acting on it. In the same vein, I do want to point out that the opinions that I am going to express are not the opinions of anyone else. They are purely my opinions. They're not opinions of contractors, employees, employers, or anybody with whom I associate. They are purely my own opinions, and I'm hoping that they actually provide value for you in understanding a little bit about what's happening. So with that in the background, let's jump right in. First point I wanted to get to is what this video is about, is what is probably going to happen in the stock market in the next little while. And when I say next little while, I'm talking the medium term, which for the sake of this conversation is probably between, say, mid-December and end of January. So we're talking, that's what I would term the medium term, kind of 50, 60 days, that's somewhere around there, anywhere between 30 to 60 days. So what I think is going to happen is a really important question. Everyone's wondering what's going to happen, and the obvious background behind why that question comes up is people want to try and make money on the stock market, or they're trying to make sure that they don't lose money on the stock market, etc., etc. So we're going to jump in and talk a little bit about the background for setting up this conversation. First thing we know is the markets are doing extremely well. We have had a bull run. Some would argue an unexpected bull run. A lot of people thought with the current health issues that we're experiencing on the planet that may not have been the case, and with all the things going on. But the reality is the markets have been going up steadily since around the March timeframe when there was that big dip. So that's in the background. And to give you a data point of what that kind of looks like, the numbers for November, when we look at the entire month of November 2020, the market rose in total. We're looking at around an 11.9, just under 12% increase in 1 month. That's just November. So some people would love that return for the entire year. Some people got that for just the single month of November. So everyone's having a fantastic time on the markets if you're on the bull side of the markets. So great job to those who've lucked out on that one. The thing I am going to show you is when I say that the markets are doing well, I don't know that that actually explains exactly how well. So here's a graph that I'm going to show you, and we can look at the graph quickly. So in this chart, I'm going to just walk you through what I'm actually seeing on the screen here. The first thing is this is from our friends who have sent us a screenshot of their Bloomberg terminal. So thank you very much for those who are supporting us. You know who you are. I really do appreciate it. So this chart is from Bloomberg Terminal, and it is showing the value of the total stock market capitalization of the entire world. So all of the stock markets added together. It is from the December 4th, 2020 date range, and it goes from 2003 September all the way up to 2020. That was this past Friday, and it is in millions. So you can kind of get a sense of what we're looking at here. It is showing you a number of things here. The one is you could see the subprime meltdown that happened in 2008, 2009, and then that we've been on a pretty consistent tear all the way up to here. This was the March dip as we realized that there was an outbreak. So that's what that looks like. And then you can see we're on an absolute tear. We're now well 10% above anything we've ever seen before. So it's not exactly a mystery when I say that the chances of this continuing to rise indefinitely is getting smaller and smaller every day. It could go on for longer than we think, but I think we're headed for a time when that will start to change. So you want to start keeping an eye on that one. Because essentially what it's showing you is that the markets of the entire planet, the entire world, are at all-time highs. We have never, ever seen markets doing this well. And that's a great statement. It's fantastic to see that things are going well. There are obviously things that are happening that are not doing so well, but in terms of the stock market, I think we can all agree things are looking very rosy there. So now let's talk about what's going to probably happen before the end of Jan. I'm thinking something in the way of a pullback, a drop, and not just a little one. I'm actually forecasting for my own purposes. I'm looking at a potential for quite a significant drop. Now, I'm not going to go into the politics of it or who's right, who's wrong about is it a recession or depression. It doesn't really matter. The point is, I suspect things are going to go down, and I'm going to talk through three main issues with a few little details under each. So here we go. First one. Not many people know that there are a number of types of investment funds that include stocks, bonds, and cash. Some people only know about index funds, and they only know about mutual funds, or they only know about the funds with which they've invested. And there are other types of funds that include a spread of stocks, bonds, these are government treasury bonds, and cash. And what happens is each of these types of funds, the ones that carry bonds inside them, they have a set of rules that get set up whenever they start the fund. And the rules dictate how much can be in each of those buckets, stocks, bonds, and cash. And so what's going to happen is every month or sometimes every quarter, depending on what the fund's rules are, they get to what's known as rebalance, where they look at, you're only allowed to hold, let's say, 35% in stocks or X many percent in bonds or X many percent in cash, whatever it is. And then they adjust and true up to what's supposed to be in the fund's rules. Now, it's the end of the year. So what does that mean? Well, if you look at what happened in November, and you remember that I told you stocks went up by 11.9%, that rapid increase means that the amount of money, the stocks that those funds are holding, has suddenly gone up by 12%, if they held a broad spread of the stocks on the market. So what that means is the percentage of their portfolio that is in stocks is now bigger than it may be allowed to be in the rules of the fund. It's got nothing to do with whether the investments are good or bad. It's just that the fund is not allowed to hold that amount of value in stocks. So what that looks like is they're going to divest of some of their stocks, and they're going to buy bonds. That's purely just to adjust for what the rules of their fund are. It's not an indication of what they think of the market. It's not even an indication of whether they think the stocks they're selling are going to be good or going to be bad in the future. It's purely a necessity to just correct for what their fund rules look like. So that's number one. There's going to be, I see, a divestiture of stocks from those funds, and I think it may be substantial enough to move the market down. And there will be a reasonably significant purchase of bonds by those funds, and that may also change what's possible inside the bond market. So those are two areas you may want to look at. Next one, the funds themselves, and this applies to pretty much all funds across the board, not just the ones that hold bonds. The funds themselves have a requirement to sell their funds. They are in the business of selling people on the idea of investing in their funds. And what that looks like is they produce a beautiful little glossy brochure that says, here's what our fund does, here's what it invests in, and here's our performance over the last X many years and quarterly and so on. Now, what happens is at the end of the year, they get to revise what their performance is based on how they've done. So what often happens is if they've had a good year, they kind of want to get as much profit locked in so that they can show an amazing return on their performance sheet so that next year more people will think, wow, that's a great fund, we want to buy into it. Now what that looks like is they may actually just say, you know what, let's just try and push it a little bit and then take some of those profits and show how amazing, instead of being up 28 or 38 or 48%, whatever they've done, they might get, let's say, let's get it to 39 or 40 if you're at 38, or let's get it to 50 if you're at 48, if you've had a bumper year, or if you've only got like 8, 9, 10%, maybe we get it to 11 or 12 and really try and push what's available to show people on our performance chart. Again, that's going to result in them potentially selling some of those stocks to lock in that performance. Another reason why I think bonds may be impacted by the first one, this has got nothing to do with bonds, it's purely going to cause stocks to get sold just so that the funds can say we made a great profit, and now you can print up a really attractive brochure for next year's customers. So those two are essentially with respect to funds. There's a lot of money that's cycled in. You probably remember about 3 or 4 weeks ago, there was a huge movement away from tech back into the traditionals, and it was a cycling of value back into the traditional stocks. So those are two important ones. The third one is a much more complicated one, and I'm banking that people aren't really talking a lot about this one. So the third one is with respect to options. Now, some people know what options are. Many people have heard the word, but many people don't know what they are. So I'll be brief. I'm not going to go down the rabbit hole of what an options contract is, but essentially an options contract is buying the right to purchase shares at some point later date in the future for a predetermined price. So if I said to you I wanted to go to the grocery store and buy a dozen eggs, and I want the right to buy them at the price that I like to pay, let's say a couple of dollars, then I want to buy that right from the grocery store, and I want to give them a small amount of money now for the right to make sure that if eggs suddenly go up, I've got the right to buy them at a much lower price, or vice versa. If I think eggs are going to go down, then I want to buy the right that I will sell them the right to say, I'll promise I'll buy them from you at whatever rate, so that they maximize their profit. So options are usually used to hedge or to cover a position, and they're very, very speculative. So a lot of people have believed or deduced that options are speculative only, and that they are very dangerous and that they're gambling. And that may be true for some people. If you don't know why you're doing it, or you're just doing it purely for a fast buck, then that would be a type of gambling. And other people actually buy them to cover a position. So you can do things like a covered call option, which is where I already hold the stock and I will sell you the right for a premium. I will sell you the right to buy that stock from me at a later date. Usually people do that so that if the stock price does go in a certain direction, there is an attractive reason to buy the stock from me. But my hope, if I have the stock and I want to make extra money on that stock, is that if I sell a covered call, no one will exercise that contract. No one will ask me to do what that options contract allows. So I hope that the options expire. So that's what an option is in a nutshell. If you want to know more about options, go ahead and leave a note down below. I'm happy to go into more detail. But here's what's important to note. We have never seen so many people trading options the way they are now. And I think there are a number of reasons. These are my pure opinions. I'm going to just tell you why I think that's what's happening. But when all the sports games shut down because of the health issues that we're having on the planet at the moment, when all of the things that people normally used to do for, sports betting or fantasy football type games and things like that, or even just going to Las Vegas, going to Atlantic City, going to whatever Fallsview Casino, wherever you go to gamble for enjoyment, those all stopped. And a lot of people decided that, we may as well, if we're going to gamble and you want to have some fun gambling, there's nothing wrong with having fun, then let's go and just trade on the actual markets, because those are still going. And that's as good as gambling if you choose it to be. If you treat it like it is, it can be. So they started trading options. The other piece that this is being driven by is that about 2 years ago, or just under, maybe just shy of 2 years ago, the brokerage houses in the US saw 1 or 2 market entrants come in and offer zero fee trading. So what that looked like when I was a younger guy and I was trading, I saw the price of a trade go from $49.99 to $29.99 to $19.99 down to $9.99, $3.99 per trade, and now it's gone to zero. So there is no money for the brokerage houses coming from brokerage fees on the actual trading of stocks. So what they've done is all said, okay, fine, you can all trade for free. You've all probably heard of Robinhood in the US. You've probably heard of Wealthsimple in Canada. There are a number of them around the world. But what they have done is said that money from stock trading is gone to zero, but money from options trading has not. So let's encourage everyone to open up an account and start trading options. And so those are a couple of reasons. There are a few others why people are trading options. But the point I'm making is, with so many people jumping into options trading, this is causing its own demand. Now, what that looks like is a few points on how an options contract is created. When one of the people who writes the option contracts, there's only so many banks and institutions that are allowed to actually what's called write an options contract. They're the ones you buy them from initially, the very first time you buy them. What that looks like is they sell you as a consumer an options contract, whoever wants to buy one. They would be like the house in a casino or the bookie in a gambling sense. If you go to the horse racing track and you wanted to buy a bet on a horse, that's what an option is. I'm betting the market will go up or down. Then the person who's selling you that bet is basically the house or the bookie. And in this case, when we look at it from an option standpoint, what they do is they sell you the option. But in the event you call them on that option, what's calling call them on the option means you exercise your right that option gave you. They have to come up with those shares. And if the market moves a lot, they could get into some really, really deep trouble. They could lose a lot of money if you were right and the market goes up, and they now have to buy the shares at that high price to give them to you because you called them, and you're only going to give them much less money. That was how the options contract would work. So what that means is when people buy options, the brokerage or the institution who writes the contract goes out into the market and buys those shares. We have never seen this much options traffic on the markets. We are at all-time options trading highs, which is great for the banks, great for the brokerage houses. Everyone's having an active time in the market, which is profitable and lucrative. There's nothing wrong with that. But what is going on is that the fundamentals of how we value stocks and what we think they're worth is now no longer the reason we're buying them. Organizations on the market are buying them in large quantities purely to underpin what an options position is going to look like in a couple of weeks, months, or however long the option is for. This next chart that I'm showing you as well from our friends who sent us their Bloomberg terminal screenshot, so thank you very much for doing that. This one is showing you all of the options trading that is occurring from the 1st of January 1991 all the way to the 4th of December 2020, and it is showing it to you based on how many options are being traded. And this is the point that I was making, is we were around the 2000 mark over here on this graph, and then you can start to see by the time we hit 2008 and 9, people started to really get into options around here, and then it started to climb up and hit a peak around the 2010, 2011 mark. We dropped back down and hit that peak again in late 2019, and then when we got into the 2020 year, things took off like a rocket ship. So I have it at the moment that people who usually play fantasy football or who go to Vegas and things like that were not able to do that. They got into options immediately, and everyone who was opening up brokerages accounts started playing with these because they were able to, and the returns can be absolutely incredible if you time your options trading correctly. It is extremely volatile and dangerous. But the point I'm making is that we were at 10,000 as the out and out limit before. We are now at 24,934 on this graph. That is 2.5 times anything we've ever seen, and it is just in this year. And that's what I'm talking about. When this unbundles and all of the underpinning shares get to be divested, when those contracts either expire, get sold, or come to fruition, then when they reach their term, the underpinning requirements for those stocks to be held goes away. And that's when all of the brokerages start to divest of those stocks they no longer need to hold to cover their positions. Really, really important point here. So what's going to happen in December and January? Well, a couple of things. Most option contracts expire around the middle of the month. And so we're going to see around December 15, a lot of option contracts will expire or get called. And when they get called, someone's going to say, great, I either exercised the option or I sold it the day before. And so the expiry of that is going to cause those contracts to no longer be in existence. And as you can imagine, if I bought the stock to underpin the contract in case someone called me on it, once they have called me on it, I no longer need the stock. Or even more so, if the option expires, what's called out of the money, nobody calls on the option, I can let go of all that stock as the institution that wrote the options contract. If you add that all together, what I'm pointing to is we've never seen so much options traffic, and that's caused so much underpinning demand. This is like a bird swirling in a heat thermal. For those of you that have ever been out into the desert and you've watched buzzards circling, they actually aren't flapping their wings, and yet they're strangely moving up higher and higher. This is pretty close to what's happening in the market. The more we buy options, the more the underpinning stock has to be bought. That makes people bullish on the options. The more they have to buy stock to underpin it, and so on and so on. And this goes up, and it could go up for a period of time. I may be very wrong. Who knows? But what I can tell you is at some point, stocks will go up until the buyers leave. No more buyers means no more stock going up. So that's going to come unwound at some point. We're going to have to unbundle a lot of these options positions, and that's just where the market's going to go. So my invitation to you is let's check back in. Let's timestamp this one. We're right in the beginning of December 2020, and I'm excited to see if this is true. I'd love to hear your comments down below. Do you agree with what I'm saying? Do you see the implications of what I've pointed to? Again, this is not trading advice. So whatever you do, make sure you have your positions the way you think they should be. Do not take what I'm saying as some form of truth. It's just my opinion. And let's check back in. I'll keep the channel going and continue to post information, and then we can check back in January. Maybe I'm right, maybe I'm wrong. If I'm wrong, I'll tell you that I'm wrong. I have no issue with that. And if I'm right, we'll look at why and whether I was accurate, and then we can play again and see what we discover together. So that's the end of this video. Thank you very much for staying till the end. I've got great news for all of you. There is a link for some free newsletter source down below. I've been really impressed with Morning Brew. It's a great website to sign up on, and then once a day they just send you the latest and most topical news. I found it saved me so much time. So go ahead and look at that. There's no cost to you. It's not for gain or anything like that. You just sign up and they send it to you. It doesn't do anything. I've given you a link down below. And second point is I'm going to be releasing another video very soon on whether you should be looking at your mortgage and what you should do with it. We're in a very interesting position in the market. I'm recording this from Canada. So we're going to talk a little bit about what that looks like in the US, what that looks like in Canada. If you want me to talk about another country, I'm happy to joint venture with you and we can look at what's going on there. But long and the short of it is I've got some exciting news and some calculations on what the mortgage market and how to really fast forward and catapult your financial future if you have a mortgage. Thank you very much for staying to the end. Go ahead and like and subscribe. We'll see you back in Jan. There'll be videos before then, but on this particular video, I'm going to repost it as a little info bubble that you can look at what I said, and then we'll see. Who knows? Maybe I'll be right and maybe I'll be wrong, but I think we're in for a very interesting December and January. Thanks for listening, and I'll catch you on the next one.